Joining us now, Eric Johnston from Cantor Fitzgerald and Unlimited's Bob Elliott. Guys, happy Friday. Bob, you think this expansion can go on for a while, even if it's paused today, because we don't have a persistent situation where yields are up, stocks are down, slower spending. Why does that mean this can go on? Why is disaster not like right around the corner?
Well, I think from a real economy perspective, we're seeing a situation where income growth remains relatively healthy. You're seeing good wage growth. That's translating to good nominal spending growth. And that's keeping the economy going and powering on. The trouble is it's a little too much in terms of inflation, which is a bit of a concern for the Fed. And it's also probably not quite strong enough to meet those sort of extreme earnings expectations that are being priced into the equity market as we move to the back half of the year.
But you think this is a good situation, still relatively speaking, for stocks?
Well, I think in general, as long as we continue to have decent nominal growth continue, you're going to have certainly a range of sectors where we'll continue to see, continued earnings growth, continued momentum. The real question is, where are those extremes in terms of pricing in very, very high earnings expectations, and how are those going to really be achieved? How are you going to get stocks with 20, 30, 40% earnings growth expectations in the context of a 5 to 6% nominal GDP growth? That's a little more questionable, and I think we're starting to see maybe some questioning about how extreme those expectations are relative to what the reality might be.